Hey everyone, Geoffrey Grace, GraceHomes.com, Remax Hallmark here at the beach, and today I want to talk to you about income properties. You've probably seen that Sarah and I bought an investment property this summer, a little semi-detached house with 3 apartments in it. And I've done a lot of posts, and a lot of people have been sending me private messages and emailing me saying it sounds like a great idea, and they want to talk about doing the same thing. But I think what is a big hurdle for a lot of people is to really understand the math, and that was a challenge for me. I mean, I've been in the business 10 years selling homes. And it took 10 years for me to buy my first investment property. A lot of that is obviously saving the money up to be able to purchase it, but a lot of it was also the unknown, scariness, not sure how this works scenario. So I want to walk, this little cheat sheet, I want to walk through the math. This is actually my financials on the property Sarah and I bought. I'm going to show you how it works. So, first of all, the house we purchased was about $750,000. So to buy an investment property, unfortunately, we need 20% down. You can't go down payment less than 20% if it's not your primary residence, if it's an income property. So what we had to do is we had to come up with $150,000 and about, let's round up, $30,000 in closing costs. So we had to come up with $180,000 to make this happen. That's a lot of money. It takes a long time to save that amount of money. But the interesting thing is we bought our first house maybe 8 years ago, moved up to our second house, have been in that for 3 years, and luckily the market's gone up. So we've been paying down our mortgage with our monthly payments, but the value's been rising, and there's that spread there. So what you can do is you can go to the bank and you can get your house refinanced. And what happens was we were able to borrow $180,000 out of our current house and use that as the money towards the down payment and closing costs. So it actually wasn't any money out of our pocket that we were necessarily needing to save. Now, I don't agree in borrowing money out of your house to go buy sports cars and fancy clothes, but if you're borrowing that money to put into an investment that's going to work in the future, I think it's a great idea. I was always of the mindset that I wanted to save up all the money and not borrow, but the thing is the market moves, and the length of time it takes you to make that money, the market's going up and up and up. It's a compounding effect. So the earlier you can get into investing in real estate, whether that be your first house or a rental, the better. Now that's costing you money, right? When you borrow the second mortgage on the house, it's costing you money. But what you're going to see in the math is it's covered by the rent from the income property. So over here is our rental. Excuse the chicken scratch. So my sheet here shows me my expenses. I've got mortgage. I've got the second mortgage, which is that $180,000 we borrowed. I've actually got a line of credit as well because we did a bit of renovation to it. We spruced up the basement suite, we moved some things around so everyone had access to laundry. There's some smart little fixes we did. We've also got the property tax and insurance. So basically our math is the first mortgage is $2,411. The second mortgage, that amount we borrowed out of our house, is $704. The line of credit is only about $25 a month on interest only. The property taxes are $200, and the insurance is $135. So monthly, that's $34.75. In terms of rents, we've got basement, main, and second floor, bringing in $925, $1875, and what do we get? $1675. So we've got rents of $44.75. You subtract those two out, it's $1,000. So what's happening is we're making $1,000 a month profit with actually 100% of the value of the house being borrowed money. Right? 80% from the bank first mortgage, and then the 20% financed from our house. And the idea is, well, $1,000 is great, but what happens if mortgage rates go up? So I actually just spoke with my mortgage broker, and we're about 2.5% right now. And let's say over the next couple of years, mortgage rates go up by 2%. So it's $83 for every percent of the mortgage rates go up. So we're looking at $164 if the rates go up by 2%, which is going to be a pretty big jump, and it's probably going to take a while So even 164 out of the 1,000, we're still $846, $836 positive every month. And the idea is that all of this is covered, we're making a profit, and these mortgage payments are paying down the principal of the home. So at the end of the day, 25 years later, 30 years later, for example, this is based on a 30-year mortgage. If I wanted to go to a 25-year mortgage, it would probably pull about $400 a month off my profit, down to $600. But this property is going to be paid off. So if I look into the future, even if real estate never goes up, I'm going to have a property worth $750,000. And at the end of the day, we're going to have no mortgage, no line of credit on this property. And so that $1,000 a month is really going to turn into $4,000 a month in terms of profit. So we're going to have 50 grand a year in income coming in on this property that's worth $750. Now the reality is real estate over the long run has been doubling every 10 years. So if I actually, and this is sort of mind-boggling, but if we look at it and we say 20 years from now this has doubled twice, we're at $3 million. I know that sounds crazy, but when we look back in time, that's what occurs, and these rents are going up. The whole thing here is finding the right property at the right amount where you can unlock some potential by using that line of credit and doing a bit of work to this. When I purchased it, the realtor who was selling it had estimated about $900 for the basement, so it wasn't too far off, but had estimated, I think, $1,500 for the main floor and $1,300 for the second floor. So there's a lot of unlocked potential in us asking for these rents, and there's a huge demand for rent, obviously in certain neighborhoods in Toronto. So that's a little bit of me actually visualizing for you how we purchased the property, how the math worked. If you've been in your house, more than 5 years, you've probably got this, if not more, in terms of equity built up in the home based on the appreciation and you paying down the mortgage. So if you think you want to look into something like this, for retirement, I'm looking at, potentially even the next one and trying to get 2, 3, 4 of these by the time I retire. Give us a call, 416-699-9292, shoot me an email, send me a private message on Facebook. I'm not going to rush you, I'm not going to push you, you can do things at your own pace, but to me this is a no-brainer, and if you want me to get a little bit deeper in the numbers with you, I'm more than happy to. Thanks a lot, have a great day.